An amazing round trip for the 10-year yield leaves us basically at the end of 2023 where we started, despite, of course, some major swings in between. Joining us to talk some more about what to expect for 2024, what we learned this year, Ed Perks is the CIO at Franklin Income Investors. Ed, thanks for being here on the Schwab Network this morning.
It's great to be with you.
So pretty amazing that we're ending basically flat. I was just saying it almost seems like a riddle that disguises everything we went through, like multiple economic cycles signaled by the yield curve throughout this year. So what did we learn from this?
Yeah, it was a unique year, to say the least. As you said, this very significant move up in yield, especially for the 10-year Treasury, August, September, October, has largely been unwound. You have to go back to July to get yields here. I would encourage people really though to step back a bit further, maybe even go prior to the pandemic. And when you compare yields today, whether it's 10-year Treasury or the yield that you can earn on investment grade corporate bonds, we still find them, quite attractive from that historical perspective. And particularly when we think about the trajectory of the economy, the trajectory of Fed policy and overall interest rates, we still think there's some yield and return to be had from bonds. So we would caution people throwing in the towel too much based upon this recent rally here.
Okay, so throwing in the towel from the bear perspective, that yields are just done going up. Maybe we get some more of that next year. Is that what I'm hearing?
No, I think it's more hey, we've had a nice rally here, right? We've had some really nice performance, the tailwind being the decline in rates. We think there's a lot more to go. So
I see.
If you're looking out over the next 12, 18 months, particularly from something like high quality investment grade corporates where you're still earning over 5% in current yields. If we were to get another 50, 75 basis points of tailwind from the 10-year Treasury over the next 12 to 18 months, that puts you into double digit total return territory for investment grade corporates. When we think about all of the economic uncertainty that still lies ahead, we think that's a good place for certainly for income-oriented investors to still be very focused.
Okay, so we could potentially get even more downside for yields here, especially when you are getting a pretty decent income still, just as it is, that kind of just nominal rate attractive. But when I hear the part about the economic risks, that's where I kind of wonder, okay, but the stock market seems to be telling us that our economic risks are subsiding. So how will that affect the bond trade? If people are looking at stocks melt up and they go, okay, why did I pull this money in a money market fund? Why come I'm not back in Nvidia or Apple or even the Russell 2000? I mean, how high can we go before people start to take some money out of that safer trade?
Well, I think you raise a couple of good points. First, in stocks, and a lot of this recent rally is certainly attributed to maybe the left tail, the more kind of worst case outcomes for the economy has been reduced. Certainly, the pricing in of some significant Fed cuts over the course of 24 and 25 has been very supportive for equities. But I think more importantly, when we think about the equity market this past year, we went through a first half that was very narrow, that was really led by a very small cohort of stocks, and I think importantly, this last a couple of months here, the rally has been much broader. It's included a wider range of sectors. It's included a much wider range of styles. So, we think that's certainly reflective of that, taking away of that left side tail, if you will, as it relates to the economy. That said, we still think there's a period of slower or moderating growth before we really should expect any kind of growth acceleration that could meaningfully drive EPS higher. So, to simplify it, to get stocks meaningfully higher, you either need multiple expansion or earnings growth. And we think those are two things that might be in relatively short supply in 2024.
Now, do you think that is because we're going to see a deeper economic slowdown? Give me the kind of 60-second macro take that you guys have.
Yeah, and there's certainly obviously what's happening around the world. There are other economies that are a bit more challenged than what we're seeing here domestically, and that certainly will play into the performance of a lot of companies in, say, the S&P 500. but as we move through and get rate declines, that certainly will be supportive of not just the U.S. economy, but the global economy. And we see out into 25 and 26, if you're willing to take a longer term horizon, the prospects of earnings growing, at that point in time. But one of the key things that we take away from companies that we're talking to, this is really across a range of sectors, is that a lot of the growth that's been delivered, especially in 2023, increasingly relied upon the ability of those companies to push prices onto their customers. And unit volumes in many cases stagnated or became relatively weak. As we enter 2024, we think price increases are going to be much more challenging for a range of companies, and it's going to be in really important for them to bring back some organic volume growth in their businesses to really drive earnings. So, we're a bit more cautious or skeptical that can be delivered in the near term. Quite possible as we're exiting 24 into 25, companies can see a resumption of growth.
Is there? It sounds like then you wouldn't be reaching into the risky side of the credit market. It sounds like the investment grade would be favorable then to the higher yielding stuff if you have doubts about the economy.
High yield is very idiosyncratic to us in this moment, right? There are attractive yields in the high yield market over the course of this past year. We've seen them as high as 8, 9, 10%. So you are actually getting compensated in certain situations. We want to be very focused on the maturity profile of those individual issuers. And if you're really forced to tap the markets, there's still relatively high interest. You might be seeing your interest expense burden increase quite meaningfully. But if you have time and the maturity wall is further out, we think those companies can be fairly attractive here because of the high carry as it relates to coupons.
Do you want to have company exposure that depends on rate cuts next year? How much conviction do you have that those will happen? Because there are quite a few companies that were flirting with bankruptcy the past year under the Fed's hikes, but now seem to be getting a fresh timeline put in front of them.
Yeah, it's a clear example of what has been headwinds for many companies and sectors moderating, and in fact maybe tilting over to being tailwinds for some of these companies. So within the credit space, like we just mentioned, companies that don't have to finance right now and access markets in a more expensive way, to the extent that they can wait and access at lower yields in the future. Certainly that's a positive. As we think about equity sectors, looking year to date, what sectors have really lagged? You find more yield-oriented sectors like utilities, like the staples and healthcare and energy, big dividend-paying sectors that have struggled because of the move higher in rates, and those certainly could be a beneficiary looking forward as rates normalize and come down.
All right. Good and sound conversation here to wrap the bond discussion on an inflation day for the week. Thanks, Ed, for the thoughts.
Good to be with you.
Absolutely. Ed Perk, CIO, Franklin Income Investors.